So what I want to do now is I want to take a minute and just kind of look at how we're going to trade options with the Ichimoku clouds and look at some of the key distinctions here. Options are a derivative, unlike stock, unlike Forex. Options, you have to kind of look at a couple different instruments, and there's a few different ways we can apply it. So let's take a few minutes here and just look at some of the distinctions that we can apply with options and Ichimoku clouds. The challenge that you're going to face when you're trading options with the Ichimoku clouds is the time component. This is always a challenge when you're trading options, but it's even more so with the Ichimoku clouds because the Ichimoku clouds are not necessarily time dependent, and the Ichimoku clouds are not necessarily trying to care one way or the other about what time you have available in your option. So it's going to be up to you to recognize that you're trading a system that's really got its focus on the big, intermediate, and primary trends. And it's going to be up to you to realize you're trading maybe a short-term tool with that. So you're going to have to make some adjustments. Let me give you some key adjustments here. You got to pay attention to your time decay. That's going to be one of your big challenges. And of course, your challenge is you don't know how much time you need to buy for that primary trend. So let's take a look. Notice this breakout we've got on Tesla. The question is, how high is it going to go and how fast is it going to get there? And you have no idea. If you fast forward a little bit, you realize, wow, this thing took over 6 months to evolve. Now, it increased 200%, the stock itself did, but how much time should you have bought? Should you have bought a leaps option? Did you know that going in? And so you didn't know the answers to these questions. And as an options trader, that's part of what you're going to have to kind of, just tweak a little bit and get more comfortable with as you're setting your trades up. So here's what I'm going to suggest to you as you're setting up your times. You can't know how long the trend is going to last. When you're dealing with a short-term option trade, you can, kind of anticipate, hey, I'm going to trade this quick swing. It's going to be a week or two, and you can buy 4 or 5, 6 weeks worth of time. When you're looking to trade a primary trend, this primary trend could be 3 months, it could be 8 months, it could be 13 months, it could be 4 years. You really have no idea. So what you've got to do is you're just going to have to recognize the limitations of your option instrument tool and then kind of constantly adapt that. If you buy an arbitrary 6 months, you could potentially be wasting premium. That makes it more difficult to make money. If you buy too little time, you're obviously going to be sabotaging your trade. So here's my rules that I want to give you. You're probably going to need to tweak this a little bit on your own. But here's my general rules. Buy 6 to 8 weeks worth of time. By 6 to 8 weeks worth of time in your option, and basically every 2 or 3 weeks you're going to be making an adjustment of some sort. Look for an exit signal 2 to 3 weeks before expiration. So if you buy 8 weeks worth of time, you got 4 or 5 weeks to see how this trade plays out, and then you start looking for an exit signal, make some adjustments. Now if the trend is still good, and here's one of the big keys right here, let me kind of highlight this as many ways as I can. If the trend is still good, roll out and roll up. What does that mean? It is not scary. It's simply this. Let's say you bought an August option for a $100 strike price and the stock's doing well. As the stock is doing well, you're getting close to August expiration. You say, I'm going to sell the August 100. That's rolling out. And I'm going to buy the November 110 strike price. And so that's rolling out. Rolling out of the initial trade, rolling up to a higher strike price. That is a great way to lock in your profit and to manage this trade with the shorter term tool that we call the option. It's really the only way to manage a long-term primary trend. Then of course, close the option trades at the first sign of any sideways move. Close it. Sideways moves are a death knell in the coffin of option trades. You cannot get stuck in those sideways moves. Your time decay will just eat up your premium in your option. Let's take a look here at this Tesla trade and look what we could have done. The initial breakout, the first breakout was for the May expiration. And so you get in there, you trade it for about 6 weeks, you hold it for just about 6 weeks worth of time, and a couple weeks before you get out of the trade, you notice that, well, the trend is still good, I'm still above the clouds, everything's still good, but I'm running out of time. So you got to sell it, exit the trade, and you got to jump into another trade. So you jump into a July expiration. There's your second entry here. Now this one happened to be a big surge here. Well, you hold that one for a few weeks, and then before you know it, I got to roll out again. You get into the July expiration here. That would become your third entry, where you could jump into another entry on the same July expiration with 3 weeks of time. Then your next exit signal here is your candlestick formation. And so you're just going to have to manage this. And as you start to manage the trade a little bit, you start to practice this. And by the way, this is a really, really good reason to go back and do that historical trading. Practice the entries and the exits. You can get out based on candlestick exits. You can get out just simply because of the time component. But you're going to have to manage these little short-term moves inside the bigger trend. Ichimoku clouds are great for helping you see that big picture primary trend, but that time component can really eat you up with your option trade. So pay attention to that. And then, of course, once you get up here, look at the right side of the chart, you see it's all highlighted in yellow. Well, you've got your price action coming into the cloud. You got your Chiku span coming into the price action. You got clear consolidation. Don't trade that. Avoid that at all costs with your option. You want to avoid consolidations. All right, that is the key there. Now let's talk about how do we trade a sideways move. Let me clarify that. I just said avoid trading consolidations. Avoid it with a trending strategy. If you do want to trade a sideways move, how do you trade that sideways move? Well, Ichimoku is very good at identifying sideways moves, but your key here is you're going to have to apply a winning strategy to that sideways move. So this becomes a good time to use selling strategies. Take a look here. The clouds are indicating some impending consolidation. Notice what's happening. Future cloud is getting fatter and fatter. Current time frame is getting, retracing a little bit. You say, well, what's this thing going to do? Well, it's probably going to get stuck here for a little bit because that's what the future cloud is indicating. What can you do whenever a stock's getting stuck? Or what can you do if you're trading currency options when a currency pair is getting stuck? The answer is you can sell options. So here's what we're looking for when we're selling options. In the sideways market, sell 4 weeks or less of time to expiration. I'm not a big fan of selling these 4 and 8 month options. I'm not into that. Sell 4 weeks approximately worth of time to expiration. The clouds need to be indicating consolidation and sell out of the money. Don't be selling into the money, hoping and wishing and praying. Once you start selling in the money, you're basically taking on a new directional trade with much higher risk. So sell out of the money. Calls are going to be at or above the cloud top, and puts are going to be at or below the cloud bottom. Let me put this on a chart so you can see what I'm talking about. Take a look at the same trade here on Amazon. Notice again, the clouds are indicating that there's some impending consolidation coming up here. So we want to sell puts below the cloud and sell calls above the cloud. Now let's run this thing forward and see what happens. And sure enough, look at that. We stayed right inside that trading range. Now, how did we know that was going to happen? Well, we didn't know for sure, but the clouds were indicating that's where it should be happening. And so certainly selling options in a consolidation like that makes a lot of sense. All right, let's talk about a few possible selling strategies. There's a lot of different selling strategies you could use in a sideways market. For example, you could sell naked calls or naked puts. You could sell bull put spreads, bear call spreads. These are the two credit spreads here. You could do a covered call. You could do an iron condor, which is selling both a bull put and a bear call spread. Butterfly is a possibility. These are all popular sideways strategies that you could use where you bring in the money by selling the option. And if you want to trade through a consolidation, typically the selling of options is going to be where you make the most consistent income. Now, here's one last thing I want to say here. The other thing that happens in a consolidation, especially if it's a consolidation in a bull market, the other thing that happens is implied volatility goes very low. So even though you can make money selling options, it may not be worth it because the implied volatility is so low, you don't get a huge premium. That's just something as an options trader you're going to have to think about. But hopefully this chunk here of video has given you an idea of how you can apply the Ichimoku clouds to your option trades.